stocks. They are being weighed down once again by concerns over the global economy. Let's bring in one of Bloomberg's most accurate ranked economic forecasters, LeBas. He's chief fixed income strategist at Janney Montgomery Scott, and he comes to us this afternoon from Philadelphia. Guy, welcome back to Bottom Line. Always a pleasure.
Thanks, Mark.
Guy, let's start in Europe, where the dollar jumped to a 6-month high against the euro today. The dollar's move came a day after European Central Bank President Jean-Claude Trichet suggested that interest rate increases were on hold. And today, we learned that ECB official Jürgen Stark, who's considered a hawk among his fellow policymakers, he abruptly resigned 3 years before the end of his term. And then there are reports that Germany's preparing plans to strengthen its banks if Greece defaults. Talk to me about the size of the challenge facing the Eurozone and whether larger economies like Germany can actually step in and help contagion from spreading.
Well, as your introduction kind of referenced, the Eurozone is facing challenges from a number of fronts. First of all, we, of course, have the Greek credit problems, which aren't growing any better. And frankly, to date, the solution has been, in order to save an over-indebted country, well, let's just lend it more money. Frankly, that cannot work in the long run. Now, one of the staunchest opponents of a Greek default has been the ECB, in part because of Mr. Stark, I think. Now, as he has clearly been at loggerheads with some other members of the policymakers of the ECB, seeing him exit may actually change the ECB's stance on what they feel the best moves are for Greece. And we could actually see the ECB be more aggressive in supporting Greek debt and other Eurozone peripheral debt in the wake of his resignation.
Now, Guy, today in Marseille, France, where the G7 officials are meeting, Canada's Finance Minister Jim Flaherty told reporters that Greece may have to leave the euro if it fails to pass or press ahead with its budget-cutting plans. Is that scenario close to becoming a reality? Will Greece be able to meet its debt commitments?
Realistically, no. As I said, it's just an extremely over-indebted country, and even the bond exchange that's sort of in progress right now is aimed at reducing that debt load. But it's not going to be enough, not nearly enough. The markets are telling us that Greece has too much debt by almost twice over. And the only way to sort of get rid of some of that debt is to default, either in an organized manner, negotiated with bondholders, or in a disorganized manner in a much worse situation. Well, when that happens, one of Greece's options is, in order to reduce the value of its outstanding debt, to create a new currency, the new drachma, if you will. And that's a classic ploy of countries that are defaulting on their debt. And that would be their sort of exit from the Eurozone.
Guy, let's get back to the U.S. What didn't Wall Street hear from President Obama during his jobs address last night? The U.S. markets, for that matter, the global markets, they're all down today.
Yeah, yesterday was a big disappointment on several fronts from the speeches. Of course, we have Mr. Bernanke having spoken middle of the day and Obama in the evening. Well, the truth is most of the sort of framework of Obama's jobs plan had been leaked out over the course of the week prior. So the markets weren't particularly surprised by what was released, and I think they're not particularly heartened by the details either now that some of them are coming forth. You know, frankly, the idea of using government spending to jumpstart private jobs growth is a very, very challenging one to work on, and I'm not sure this plan really does that well enough or could do that well enough, even in an ideal form.
Guy, Treasury Secretary Tim Geithner, he is in Marseille as well, attending that G7 summit. He told my colleague Peter Cook today that the president's jobs plan would provide what he called a substantial boost to the U.S. economy. And again, quoting here, he said it would dramatically reduce the risk of a long period of much weaker growth. Did you hear anything in the president's speech last night that leads you to believe that his proposal would in fact provide a substantial boost to the economy?
Well, I think it certainly will for 2012. I mean, we're talking about a fair amount of an increased spending on infrastructure, a fair amount of tax cuts, and that is economically beneficial. In fact, we estimate it'll double our expectations for 2012 growth to a still decent, not great, about 3.5% or so. But there's really nothing in there that suggests we can really sort of put the cables to the engine and jumpstart things so that it'll be going on its own. Because frankly, the reason firms aren't hiring is because worker productivity is high. They're reasonably profitable as is, and they don't see higher sales prospects. Cutting taxes, cutting payroll taxes, doesn't fix the fundamental problems, and I'm afraid to say there's really nothing out there that can fix those problems, not in terms of policy.
Guy, final 30 seconds, that figure that the president was gunning for last night, over $440 billion, given the climate that we find ourselves in right now, is that enough?
Well, it would be enough. At the same time, a lot of that is just going to go to contradict what Congress passed barely 4 weeks ago in cutting the federal budget over the course of the next decade or so. So we're sort of getting this almost schizophrenic policy reaction. We have austerity on the one hand, stimulus on the other. Do these cancel each other out? And I think that's a big intermediate term to long-term problem for the U.S. policy.
Guy LeBas, Chief Fixed Income Strategist, Janney Montgomery Scott, joining us from Philadelphia. Guy, it's always a pleasure. Have a good weekend.
Thank you. Same to you, Mark.